Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. This is the first in a series of micro lectures that we are going to do on a variety of financial management, business strategy, economic subjects, really different subjects that we think are very important for business owner operators and investors. And as we go through these lectures, I'm going to present these concepts in kind of bite-sized chunks. That's why we call them micro lectures, because we think it's really important to break these things down into their elements and try to master them from there. So the best place to start, I think, is in a concept called the time value of money. The way the time value of money works, we're going to see this concept in so much of finance. It's going to be the basis of valuing different investments, value in real estate, value in businesses, value in stocks. So it's the best place to start. It is, if you take a finance course in school or something, this is usually addressed pretty early, which kind of highlights the importance of it. Think about the time value of money in two ways. The more kind of intuitive way, I think a lot of people know that if you received $1 in the future, that dollar is going to be worth less than $1 today. There's going to be two basic reasons for that. One is you're going to have inflation, so you're going to have a decline in the purchasing power of that money over time. And the second thing is you're going to have foregone interest. So you're going to have the interest that could have been earned had you put that money into a bank account or some other investment instrument. And a little bit more formal definition, we can think about time value of money as a set of mathematical tools that can help us find the equivalence between future money and present money. That's really the essence of time value of money. That's really the essence of valuation as we see. So what are the general tools for these calculations? They really just fall into two categories. One is compounding. So we'll think about taking a present amount of money and investing it and reinvesting the returns. So we're going to earn kind of interest on interest, or we can think about it as an investment gain on an investment gain. And over time, that amount will grow exponentially. The second tool that we're going to use categorically is called discounting. And this, when we discount, we're really just working in reverse from compounding. So when we compound, we're taking a sum of money today. We're trying to find the future value. When we're discounting, we're taking a future amount, and we're trying to find what that future amount is worth in today's dollars. And it's the same thing. We'll actually see with some of these equations, they reverse each other out. But it's the same idea as far as those returns being reinvested. We're also going to see with these time value money calculations that we are kind of playing with a few different variables, and all of the equations that we show, we're going to see the same variables come up. And I should say, we can do these calculations pretty easily in Microsoft Excel, and we can do them with a financial calculator. And I will put together videos where we do these things in Microsoft Excel. But I want everyone to kind of understand the math that's going on. So I think it's important to see these equations and to work through them by hand, at least with a few of them. And again, I really want everyone to kind of to really master the fundamentals before we move on to more advanced subjects. So the first variable, we're always going to need to know the number of years that we're working with. We're always going to need to know the time. And that's usually going to be denoted by a capital N or a lowercase n. We're also going to have the compounding intervals. So if we're compounding, say, monthly, we're going to have 12 intervals. If we're compounding quarterly, we're going to have 4 intervals. For compounding daily, we'll have 365 intervals. So that's always going to be a given in these calculations. We're also going to need to know the rate of return, the interest rate, and that's usually going to be denoted by R. And then we need to know the future amount. Now, depending on the kind of equation that we're working with or the kind of problem that we're dealing with, we may actually be trying to find the future amount, or we may be given the future amount. Same thing with the present value or the present amount. That's usually denoted by PV, and future amount is denoted by FV. And we're usually trying to find one of those variables. We're trying to find the future amount, or we're trying to find the present amount. But with these equations, we can try to find the other variables as well. If you guys like these videos, we're going to continue to crank them out. But if you like them, you can do us a huge favor, and you can subscribe to our channel, and you will get these videos as they come out. And that'll be an enormous help for us to produce new content and to try to create as much educational content on the channel as possible. So that's a huge help to us. Thanks so much, guys. We'll see you on the next lecture.